in a typical 4-year cycle, whenever the price crossed the low of the quick moving average, so quick EMA, the Bitcoin's bottom for that particular cycle was already in basically the bear market. This signals that bear market is over. Of course, one cannot catch the bottom if we are following just the moving averages, but it adds to the confluence of the analysis, which tells us, all right, I am out of the bear market, the bottom has already formed, and now I want to start moving in the trend. I want to start taking positions which would be going in the next bull run. Over here, we had this first close. One could have entered here, but then there would be a flash crash here. But let's say if a person is not trading, if one is investing from and looking from a 4-year cycle point of view, then this would have been a good potential entry, thinking long term. Then another good entry would have been over here. So this too would be good point to DCA. During the bear market, when the quick EMAs are red, we see that, or not red, but when the price is under the quick EMA, it's better to not go DCAing, because the chances of losing on that DCA are much higher. The risk to reward ratio doesn't add up, because someone is taking a risk at this point or at this point thinking that we are back in the bull market, but the reward is not favorable because the trend is still going downwards. At first point when I would like to take the risk when QEMAs are still red is when the price crosses the QEMA with low as the point. So here the first one or the lowest one is the low, which is this one. So if it crosses the low, that means I have broken the structure where it was basically taking into consideration the lows of the last 50 candles. And once it has crossed the high, that basically tells us the break of market structure from the last 50 candles, just the high of the last 50 candles. It's an average, so it's an average break of, it's a break of structure of the average of the highs. For today,